Have you ever dreamed of getting in on the ground floor of the next Amazon or Tesla? Well, what if I told you that that opportunity is out of reach for you and me and the rest of humanity by design? Let's look at SpaceX and Tesla. SpaceX is a private company, whilst Tesla is public, meaning that you as an individual can purchase a part of Tesla whenever you want, provided that you can afford the stock itself. This usually means spending $300 to $400 depending on the share price. On the other hand, if you wanted to invest in SpaceX, it wouldn't be that easy. You'd either have to be a part of a venture capital fund, a larger private equity broker, or know the founder, that's Elon Musk, personally. Not to mention, you'd normally have to spend hundreds of thousands of dollars to even be considered as an investment candidate. So, going public for a company these days is more of a sentimental milestone as compared to years past. And this is primarily because companies often have their most explosive growth in the period of time before going public. Let's take a look at DoorDash's year-on-year growth before it went public and after it went public. From 2018 to 2019, DoorDash's revenues increased by about 204%. And then again from 2019 to the point it went public in Q3 of 2020, those revenues increased by about 117%. And then, following their IPO in late 2020, their growth numbers and percentage of revenue growth begin to dwindle, as you can see in the graph. So how and why do companies grow so aggressively before going public? Well, there's a few reasons. When they're private, companies are funded by venture capitalists, private equity funds, and angel investors who encourage aggressive growth strategies. These investors are willing to take risks in pursuit of high returns, and this in turn pushes the company to prioritize rapid expansion, market share dominance, or product innovation over short-term profits. Secondly, to secure even higher valuations and attract marquee investors, companies often amplify their growth trajectory. This creates a sense of urgency amongst investors, further fueling the cycle of expansion. Basically, they want to create a fear of missing out amongst the super rich. And finally, this inflated valuation is also a way for pre-IPO companies to attract top talent by promising them equity-based compensation, which can be extremely valuable if the IPO goes well. So you can see, to really have a chance at getting in on the ground floor of a company that could then become the new Amazon or Tesla or Apple, and then getting huge returns on your investment, you'd need to already be fairly wealthy. But it wasn't always like this. In the past, companies would go public earlier to raise more capital. For example, Microsoft first went public in 1986 with a market cap of about $780 million, and the opening share price was an affordable $21. This gave ordinary retail investors like you and me a decent chance to grow their wealth alongside the company, and it also indicated that there was still a way to go for the company itself and establish more of its business model in the future. However, compare that to a company like Stripe, which we covered extensively in my last video, which is already valued at over $50 billion, and it still isn't listed on any public markets. If and when the company does go public, I can assure you the stock price is not going to be anywhere nearly as affordable as Microsoft's was back in the day. And this is all part of a larger trend which has shown that fewer and fewer companies today are interested in going and remaining public. In 1996, there were over 8,000 publicly listed companies on American stock exchanges. Today, that count has dropped by more than 50% to just over 3,700. And it's not that there are fewer companies in the United States. It's simply that more and more corporations are choosing to stay away from public platforms. We are now at a point where there are about 5 times as many private equity-backed firms in the US as there are publicly held companies. In 1999, the average American tech firm transitioned to the public markets after 4 years. By 2019, that figure increased to 11 years of private ownership. This is not a good sign, because this invisibility from the public also leads to a consolidation of power and lack of competition. For example, just 2 stocks, Apple and Microsoft, account for about 15% of the entire S&P 500. And this raises a very important question. Why are these companies choosing to stay private for so long? Well, there are 3 big reasons for this. The first reason being that private capital firms just have more financial resources to offer to the companies they invest in. For example, in 2018, private equity firms invested roughly $131 billion in biotech and tech companies alone. In comparison, IPOs brought in less than half that figure, roughly $50.3 billion. And that's just one part of the story. Private capital also allows these firms to actively acquire and delist public companies from public exchanges. For example, following the bear market washout in 2022, private equity firms seized and delisted several public companies, reportedly spending almost $110 billion within the first half of 2022. The second major reason is that by staying private, companies sidestep a lot of the regulations like the Sarbanes-Oxley Act, which are imposed on publicly traded companies by government institutions like the SEC, which ensure the transparency of business activities and help maintain investor confidence. By staying private, companies also don't have to deal with activist investors, which are shareholders who attempt to influence the company's operations or strategic direction for their own personal benefit. An example of this is WeWork, which tried to go public in 2019. Their IPO collapsed due to a combination of concerns over corporate governance, valuation, and the personal behavior of their CEO, Adam Neumann. Now, this might have happened while they were private, but a lot of these issues were highlighted because they went public. And finally, staying private allows founders to retain better control of their companies, which allows them to make more or less unilateral decisions without having to appease external shareholders or face the risk of being ousted by a hostile takeover. They also don't have the pressures of meeting any quarterly earnings expectations and can focus on what they actually want to do. All of this sounds logical, right? But this is not good news for the average retail investor like you and me. The issue with companies being private is that by the time they go public and are available to retail investors, they are already fairly mature. For example, Uber went public in 2019 with a valuation of roughly $75 billion, but it was worth much more in private funding rounds during its rapid growth phase before going to IPO, which is precisely why private investors like SoftBank reaped huge gains early on. Another big problem with companies existing solely on private markets is that these markets are dominated by massive institutional players. These are shadowy figures that operate behind the scenes, like BlackRock, Thoma Bravo, and the Saudi Arabian-run Public Investment Fund. As of June 2023, the total assets under the management of private market institutions in the United States totaled over $13 trillion. That is 260 times the GDP of Iceland. And this represents a huge decline in investment opportunities for people like you and me who want to diversify our retail portfolios. You are left with relatively little choice as you cannot dictate which companies will go public, when, and where. And the only realistic way to be able to invest in these private companies as an individual is if you are an accredited investor. But what is an accredited investor anyway? An accredited investor is an individual or a business that is allowed to buy and sell securities that are not registered with financial authorities. To put it simply, imagine you go to a candy shop and you see a huge variety of candy available. But before you can actually go and buy some, the shopkeeper comes along and tells you that 30% of the candy is what's actually available to buy, and if you want to buy the rest, you need to be accredited, which means that you need to have an income over $200,000 a year, or $300,000 if you have a spouse, or you have a high net worth, which exceeds over $1 million, excluding the value of your current home, or you have specialized knowledge of candies and have a set of candy certifications. Oh my God! A question you might ask here is, why the shopkeeper is setting limits on what candies you can and cannot buy? Well, according to the shopkeeper, it's because the candies might taste terrible, like losing money on private investments. The candies take a long time to release their flavor, like the non-liquidity of private investments, or the candies are unsafe and unhealthy, like private investments that are less regulated. But in reality, this system so far has served nothing but to keep these high-risk, high-reward opportunities closed to the average investor. Even if you're an expert in an industry and feel comfortable losing large amounts of money, you won't be allowed in because you just don't have that kind of net worth. And that means that if you ever want to invest in the next Apple, Amazon, or Tesla, well, you better be a millionaire. Thankfully, however, the discussion on private markets is beginning to change. In 2024, a group of American lawmakers proposed legislation that would allow any investor capable of passing an exam to buy private securities. The idea is that the ability to make these high-risk, high-reward bets should be open to all sophisticated investors, and not just those with the biggest bank accounts. And while crypto may be full of scammers and rug pullers, it is a step in the right direction, as decentralized finance, or DeFi, offers an alternative path for people to invest in tokenized assets or startups via blockchain. There are also several platforms now like Seed Invest, WeFunder, and Republic that allow retail investors to participate in early-stage funding, with some limits. A good example of this was Legion M, which raised millions through equity crowdfunding on WeFunder. The biggest wealth-building opportunities are increasingly locked behind the doors of private markets. The question is, how can we change that? And if the right changes are made, would you invest in private markets if given the chance? Or do you think they're too risky? Let me know what you think in the comments. Thanks for watching. Remember to subscribe so that you can continue to solve some more money mysteries.